Axios. Dan, let me ask a question that may seem a little esoteric here. Is this a failure of the company or a failure of the IPO process as practiced by the company?
I think it's both. I mean, the reason this one got into trouble in the first place was, and Leslie talked about this a little bit, some of the really weird governance stuff that was around this, some of the payments that the company had made to CEO Adam Neumann. These are things that the company, that its advisors, everybody should have worked to clean up long before any of us ever saw the S1, before any prospective investors did. As for the IPO process, I don't think it's necessarily a failure of the process. There are, and we wrote about this at Axios today, there are some calendar issues here in terms of the Jewish high holidays coming up, the end of the third quarter, that if they didn't launch it yesterday or today, they kind of have to wait until the middle of October.
This valuation, I don't remember one that swooned as quickly as this one. But there's the small matter of the $2 billion trailing loss and the even smaller matter of $47 billion in lease obligations, something that you write about in your book, about knowing what is in your leases. This sounds like a real millstone around what ultimately could be a public company. Dan?
For me, yeah, not my book, somebody else's book.
No,
but
I'm talking about Tillman's book.
Oh, Tillman's book. Good. I was going to say, I was thrilled I had written a book. Easy work. No,
Tillman was thrilled he's written a book, man. Go ahead, finish your thought, Dan.
It could be. I mean, the argument from WeWork, obviously, is unlike things, say, like Uber or Lyft, which are asset light, WeWork is asset heavy. Even though it doesn't own most of the buildings, it puts an enormous amount of money into rehabbing them, to getting them to be like a WeWork. And their argument is, and they'll say, look, we've got a backlog of, I think, $4 billion worth of contracts for the next several years. They say, you know, you get a lot more money in years 2, 3, 4, and 5 than a lot of the other companies, these other unicorn companies have gotten.
Tillman, you got a thought on this?
I definitely have a thought on this. This one is really interesting. First off, what he said about they had different problems with their process, with some cleanup they needed to do, but they're the poster child right now for something that has chapped me forever. And we were so interested in buying growth that we forgot about value and making money. And I'm a sticks and bricks guy that had to do it one by one by one. So the whole technology balloon has always, I knew it was going to come back. And all of a sudden now, you see Uber, you see Lyft, you go back to like your companies like Blue Apron, all the hype, only revenue and no profit. Well, everything at our kind of companies are, you got to make a profit. They're signing leases all over the country that they have huge liabilities on, that if they can't fill up, they've got lots of issues. This is a great company. It was a great idea, a great concept. My good friend Rich Handler's son, Max Handler, works there. He tells me they're working their tails off. They work late. They have a great culture. They're a great company, but they have an issue. You got to make money at some point.
You got a $2 billion loss.
Wall Street has finally decided you're going to have to make money or we're not going to buy your stock. And when the people that get into the private placements now can't even get out when the company goes public, that they overpaid, it is a horrible backlash. And it's something that's been coming to these tech companies for years and years. And they get what they deserve. You got to make money.
Can I just respond to that real quick?
Please, sure.
Just quickly, if you look, though, I just saw there was a thing of Beyond Meat up there. Beyond Meat doesn't make money. The markets love it. If you look, even most of the companies, the so-called decacorns, in other words, the ones that were valued at $10 billion or more in the private markets, most of which were losing money when they went public, most of those are worth more today than they were in the private markets. Definitely Uber, Lyft, clearly WeWork. These are specific issues. I don't think it's an indictment on how the market is viewing the overall technology sector.